Good morning, everyone. My name is Geraldine Serrano. I am a specialty tax consultant with the Veritax Advisors. So today, I'm going to talk about a tax strategy called cost segregation. Has anyone heard of this tax strategy? So you have?
Yes, just high level.
Oh, okay, great. Well, I want this presentation to be as interactive as possible because I've been in the industry for about a decade and most people I meet have never heard of it. And there are some people that have, but I want to make sure that I provide information that's helpful to all of you for those of you that,
really, just since she's on Zoom.
what was that? Somebody said something about Zoom.
It was just someone from the office that was trying to get things set up. So not.
Okay. Okay. Well, so what I'm going to do is I'll share my screen so that we can get started. So it's coming up on tax time. So cost segregation is a strategy. Is a strategy for both residential and commercial real estate investors. So if you know you're going to owe the IRS, then this is definitely a strategy that if you have real estate investments that you should consider. So the story that I like to tell is there is an investor that called me and he was referred to me from a client of mine who told him to reach out to me because this guy, his name is Mr. I Hate the IRS. He called me and said, Geraldine, I have my tax return in my hand, ready to sign and mail to the IRS along with a check for $100,000. And my friend, who's a client of yours, told me to call you to see if you could do something where I don't have to send a check to the IRS for $100,000. And I told him, send me some information on your real estate investments. He owned 12 single family homes that were rentals in Colorado. And so I said, send me some information and I'll have my team and I look at it and see what we can do. So my team and I looked at it, or looked at the information he sent me, and I called him and I said, if you don't want to pay the IRS $100,000, you don't have to. And so, and he said, that's great. He said, how are you going to do that? And I said that when you own property, you are typically buying two things. You are buying the building and you're buying the land. Now, out of those two, which do you think gives you a tax benefit? If either one gives you a benefit at all, is it the land or is it the building? Anyone want to take a guess? And you could put it in the chat. So from the building, you get, Laura, you're right. And so are you, Manpreet. It is the building. So from the building, you get a non-cash tax deduction called depreciation. You don't get that from the land. The land's not depreciable. So when with the building, every year you get this annual depreciation that you can use to lower your tax liability. So in the case of Mr. I Hate the IRS, all the annual depreciation he got from those 12 rental properties from the building still left him owing $100,000. So I told him what we need to do is we need to squeeze out more depreciation from those buildings to get rid of that $100,000 tax liability. And the way we're going to do that is with a cost segregation study, which is a detailed engineering analysis of the building. What that means is it literally breaks out that building into every single component that was used to construct that building. And it identifies which parts of that building can give you more depreciation than the standard annual depreciation that you get every year. So when you do this cost segregation study, inside the building, it's going to find assets that can be depreciated faster. We're going to find 5-year assets like carpet, decorative lighting, cabinets, wall coverings. And outside the building, we're going to find land improvements that can be depreciated over 15 years. And that's going to be items like asphalt and landscaping. Now, if you don't do a cost segregation study, the entire building is going to be on a certain depreciation schedule. So residential properties are depreciated over 27.5 years, and commercial properties are depreciated over 39 years. So what that means is every year for 27.5 for residential properties or 39 years for commercial properties, you get a certain amount of depreciation that you can use to lower your tax liability. I'm going to pause right here because I want to make sure this is an important piece because this is the basis of a cost segregation study. Does anyone have any questions about those numbers? Okay.
Hi, Geraldine, Johnson here. Why is it capped at 27.5 for residential?
Good question.
Just hyper focused on that number.
Sure. So my company follows the IRS's guidelines, and the IRS is the one that gave these numbers that says that a residential property can be depreciated over 27.5 years and a commercial property can be depreciated on 39 years. We don't know why they chose those numbers, but that's the number that we have to use when we do our taxes.
Okay, thank you.
Any other questions?
Yes. Are you planning to take some examples, like maybe take 1 million property and then how the average depreciation will be across these 27.5 years versus like if we do this cost segregation, how that will differentiate? Are you going to be sharing those examples as well?
Yes, but to make sure while we're on here that people can follow along with these numbers. So
Questions, please.
let me pull up a calculator.
Thanks.
Okay. And that's great that you brought up the example of $1 million. So let's say you buy a single family home in San Jose for $1 million, right? So part of that purchase price is going to go to the building and part of it's going to go to the land. So let's say 75% of it goes to the building. So now the building value is $750,000 and the land basis is $250,000. But for our purposes of talking about a cost segregation study, we're going to look at the $750,000. So this is a single family home. So this property is going to be depreciated over 27.5 years. So what that means is every year for 27.5 years, you get $27,272 that in annual depreciation, you can use to lower your taxes. Any questions on that so far?
No, makes sense. Thanks.
Question.
Okay, great.
Go back to the earlier we were asking. Now you were saying 5, 15, and 27 and 5 and so forth. It's if you're taking 5 years deductions, can you still take 27.5 as standard to add on?
So with a good question. With a cost segregation study, you can't accelerate the entire basis, right? That 750,000, you can't accelerate it where you can use it over 5 years or 15 years, right? We're only going to be able to identify a certain percentage so of the 5 and 15-year property. So on average, a cost segregation study can move between 20 to 40% of that building basis, which in this example was 750,000, into a faster depreciation schedule of 5 or 15-year property. Everything else has to remain
27.5
on the 27.5 or the 39-year schedule.
So for example, the 5 years on carpet, paints, and whatever furniture you put in, you put that on the 5 years depreciation, so that accelerate that.
Right.
If you subtract 750 in any way, if you take in that 5 years acceleration depreciation.
So this is how it works. So let's say you bought that single family home in San Jose last year in 2022, right? So, and you're getting about 27,000 in depreciation, right? So when you file your taxes for 2022, you're going to subtract 27,000 in depreciation from that building basis. So now for 2023, you're going to show a building basis of not 750,000. You're going to show a building basis of 723,000 because it's going to be the 750 minus the annual depreciation. So you're going to see that building basis drop every year by 27,000 because that's what you get to use in depreciation to lower your tax liability.
Okay,
Does that make sense, everyone?
that's over 27.5 years. The
Correct.
deduction.
Correct, for a residential property. Commercial properties are on a longer depreciation schedule. They're depreciated over 39 years. But for our purposes, when we're talking about a residential property, yes, it's 27.5 years. And just to stick with that, a cost segregation study can be done on any property, whether it's residential or commercial, right? ADU, even if you're doing renting part of the home and doing Airbnb or a long-term rental, condo, duplex, fourplex, multifamily, and commercial, anything under the sun, hotel, senior care facility. Anyways, but the only building it cannot be done on is a primary residence or a vacation home. It has to be an income producing property. Any questions so far? Okay, so I'm going to keep going. So these rentals in this example were in Colorado. So the question that the Mr. I Hate the IRS had was, Geraldine, you're in the Bay Area. My properties are in Colorado. Is that going to be an issue? And the answer is no. My company is nationwide, so we can do a cost segregation study on any property located in the 50 states. Now, Mr. I Hate the IRS was concerned about being audited. Well, my company provides at no additional cost an audit defense. So what that means is if you're ever audited, we will be the ones to help your tax preparer answer any question about our report. But since I talked about the building and land split, what becomes important is what is on your tax return. We'll defend the report, but we're not going to defend the numbers you choose for the building and the land, because you can be as aggressive or conservative as you want to be with those numbers. Obviously, if you choose a higher number to the building, the more depreciation you get. But at the end of the day, you and your tax preparer are going to be the ones to defend that number. We won't. We'll just defend the report, but not those numbers. Laura had a question of how does this apply to condos? So in a condo, we're going to find the 5-year property, right? If you don't own any of the land, then all we've got is just the condo. We're not going to find any land improvements. There is no land. So inside the building, the example I like to use is if you were to turn the condo or the building upside down, whatever would fall out is what we would look at. So in a condo, we're gonna look at the carpet. That can be depreciated over 5 years. In the kitchen, we're gonna look at the cabinets, the countertops. We're gonna look at any wall coverings. We're gonna look at decorative lighting. So there's plenty of 5-year property that we can find inside the condo. Laura, did I answer your question? Okay, great. So now that I've talked about the audit, all of our work comes with a physical inspection. And the reason is, since we do provide that audit defense, we are physically going to go to the property for a number of reasons. We go to the property to take pictures, notes, and measurements, which are going to be part of the report. So if you're audited, we will have all the information from the inspection of what was there at the property. Also, you're paying us to find every single component that can give you more depreciation than the standard depreciation. So without physically seeing what's there at the property, we'll have no idea what we would find. So that's why we always do a physical inspection when we do a cost seg study. Now, typically it takes about 30 days from the completion of the inspection to finish the report. However, we know that during tax time, if you need a report sooner, then my company is set up to get that report to you and your tax preparer in less than 30 days if you need it. Obviously, that's not ideal for my team, but we can do it. Now, any questions so far about that first part that I explained? Okay, so now I'm going to go into examples of if you do a cost segregation study or if you don't do a cost segregation study. So 2 different real estate investors bought a single family home for $1 million in 2022. One of them did a cost segregation study and one of them didn't. So so one of the investors got over $300,000 in depreciation, in accelerated depreciation. So they were able to lower their tax liability and not worry about having to pay the IRS $300,000 in taxes. So another investor who didn't do a cost segregation study only got under $20,000 in depreciation. And that's because they didn't do a cost segregation study. So actually, I'm sorry, I apologize. So this is the example that I use. One investor got 1.2 million in accelerated depreciation because they did a cost segregation study, and the one that didn't only got 60,000. So that's a difference of over $1.1 million in depreciation expense. So now you can do a cost segregation study if you've owned the property for a while. So there are 2 different investors. I'm going to go through another example where they bought in 2015. One did a cost segregation study and one didn't. So the one that did a cost segregation study had a cumulative depreciation expense of $600,000. The one that didn't do a cost segregation study, they only got $240,000 in cumulative depreciation expense. And that's a difference of $360,000. So obviously with these 2 examples, the real estate investors that did a cost segregation study got to enjoy the tax benefit that they received from doing one. So what was the biggest difference with the first example? Why did the real estate investor that bought last year, that single family home, why did they get the most in accelerated depreciation? And the answer is 100% bonus depreciation. Back in 2017, the tax laws changed where if you've purchased or newly constructed a property after September 27th, 2017, whether it was new or used, it became eligible for something called 100% bonus depreciation. What that means is that you didn't have to wait 5 or 15 years to get all of that accelerated depreciation. You got all of it immediately. Now, bonus depreciation decreased by 20% this year to 80%. So is it still a good time to buy real estate? Sure it is, because 80% versus 0 is still better. Now it's going to continue to drop by 20% until it hits 0 in 2027. Any questions so far?
I have a quick question. This is Manpreet. So this segregation helps only if you are keeping the property only for a few years versus, let's say, if I want to keep the property for 28 years, that wouldn't make any difference. Is that right?
Correct. So once you get past the 27.5 years of owning that property, it'll be fully depreciated and there'll be no depreciation left.
Right. And if I sell that, let's say if I get that segregation and I get the accelerated segregation and I get the depreciation, and after a year or two, if I sell that property, I'm not gonna be due for any taxes on that one, right?
So there's a couple of things. So Manpreet, that's a great question. So we don't recommend doing a cost segregation study for flippers. If you're going to flip the property within a year, we don't recommend doing cost segregation because you have to be concerned about when you sell the property and the capital gains tax, right? If you sell it for a property, you got to be concerned about the capital gains tax. So if you do a cost segregation study and you take the accelerated depreciation, all you're going to do if you don't do a 1031 exchange is increase how much you're going to pay in capital gains tax. But for most investors, the way they deal with that capital gains is they do a 1031 exchange. So they're always deferring that capital gain, right? So it just depends on what your tax strategy is. But if you are going to keep the property for more than a year and at least 2 or more years, because typically investors hold on to properties for 5 to 10 years. If you do a cost segregation study, typically you either break even or you still come out ahead. But with my company, we always do an estimate at no cost. So you can see what the numbers look like. And that way you can determine whether or not it would be a good strategy for you to do a cost segregation study now or not.
Thanks.
Any other questions? Okay. So if you do a cost segregation study, and let's say it gives you $300,000 in tax savings and you don't need to use all of it. Let's say, for 2022, you only owed 50,000. Well, it's not a use it or lose it situation. So I describe it as you're setting up a cost segregation bank. So you set up this bank where in that example, you have $300,000 in this cost segregation account in the bank. And you only needed to pull out 50,000. So now you still have 250,000 left in that cost segregation bank that you can use in the future when you need it. So People will ask, when is the best time to do a cost segregation study? And the answer is right after purchase. And there's a number of reasons for that. You can still do a cost segregation study if you've owned the property for more than a year, but there will be more work involved. You'll have to file an IRS form 3115 telling the IRS that you're changing depreciation methods. You're changing from the straight line depreciation method to the accelerated method. Also, you'll have to submit 481A calculations, telling the IRS how much depreciation you've taken and how much depreciation is left on the table and how much accelerated depreciation is left on the table that you're going to use now. Now, your CPA or a third party can either will typically charge an hourly rate, or there are providers out there that charge 1,000 or more. So you just have to keep in mind that you can do a cost segregation study if you've owned the property for over a year and it's already on your tax return. But just know that you would have to submit the form 3115 and the 481A calculations if you were to do that. So it just requires more work, and you may have to pay for that. Now, with my company, we assist your tax preparer with that 3115. We have a template, and we help your tax preparer with that form at no additional cost. We also provide at no additional cost the federal 481A calculations. So from my company, that's what we would provide to you if you were to do a cost segregation study on a property you've owned for more than a year. Any questions so far about that? Okay. Now, also, you may want to do a cost segregation study right after purchase if you plan to do any renovation, do any improvements. So if you are, a lot of investors will buy property with the intention of doing renovation so that they can increase the rents. So in that scenario, what I would recommend is a two-part study, where the first part of the study would capture the accelerated depreciation on the building as is, and the second part of the study would capture the accelerated depreciation on the improvements. The first part of the study would also help with what's called partial asset dispositions. What that means is the IRS says you can write off the remaining basis of anything you throw away, but you have to do it in the year that you dispose of these items. So it's really important that if you want to take advantage of writing off the remaining basis of anything you throw away, we have to be able to see what those items are going to throw away before you actually dispose of them. Because when you don't do a cost segregation study on your tax return, you only see two line items. You see the building basis and the land basis. That's it. So if you're throwing away carpet, if you're replacing the roof, if you're putting in new windows, there's no value attached to those items. With a cost segregation study, it's literally breaking out that building into every single piece that was used to construct it. So whatever you throw away, you will just find it on the study, and your tax preparer will be able to calculate what is the remaining basis of that particular item. Any questions so far about that piece? Okay. Now, a cost segregation study can also be used when there's a step up in basis. So estate planning attorneys or CPAs will call me when there's a death in the family and there's real estate investments involved. So even if the deceased did a cost segregation study on all the real estate investments, once they pass away and the step up in basis happens, that resets the depreciation clock. So the heirs can then do a cost segregation study on the real estate investments, even if the deceased did them before the deceased passed away. So that's just a situation to keep in mind if if you want to take advantage of getting the tax benefits in that situation. Also, like I mentioned earlier, when I talked about the 1031 exchange, you can also do a cost segregation study if you're doing a 1031 exchange. You'd want to do a study on the relinquished property and the new property if you want to maximize the tax savings you would receive from the study. Before I move on, any questions on that? Okay. Now, the cost segregation study results are applied differently in different tax situations. And what I mean by that is if you are a W-2 employee, the results of the cost segregation study are going to go against your total passive income. If you, from your W-2 position, if you make a six-figure income, unfortunately, the results cannot be used to be used against your income, unfortunately. But if you are considered, so it would be, it'll go against your total passive income. So, but if you're if you meet the IRS's definition of a real estate professional, then it's going to go against your total ordinary income. So wherever you make money, right? If you're a realtor, a real estate broker, or even if you're just an investor, if you put in 750 hours in real estate activity, and you meet the IRS's definition of a real estate professional, then those results of the study will go against your total ordinary income. Wherever your income's coming from, that's what it's going to go against. So I'm going to give you an example what I mean by that, or on how the cost segregation study works. So you're going to take the rental income from the property, and you're going to deduct the expenses. You're going to deduct interest, utilities, maintenance, and insurance. So once you deduct all those expenses, you're going to get the net income. Now, if you don't do a cost segregation study, you're going to deduct the annual depreciation you get from the building. So in this example, they're going to deduct $58,974, which will leave them with a net taxable income with over $100,000. So they're going to be taxed. Their taxes are going to be $46,587. Now, if they were to do a cost segregation study, they're looking at a depreciation expense of over $1.2 million, which is going to show a loss of over $1 million. So like the example I used in the beginning with Mr. I Hate the IRS, this is a good example to show how the cost segregation study wiped out his $100,000 tax liability. Any questions about this example? Okay. So it would be nice if when you submitted your tax return for federal and state, if they would give it back to you and say, you missed this write-off deduction, but they don't, right? I'm sure we all wish that they would give us back our tax return and say, for example, you could have done a cost segregation study on your real estate investments. Go ahead and do one, then submit your tax return, and then you don't owe us anything. But the fact of the matter is, the federal and the state don't do that. So for all of you who didn't know about cost segregation or only heard of it, hopefully from the information that I shared today, you know that this tax strategy is available to you if you're a real estate investor, or if you know someone that's a real estate investor, please share this information with them so that they know that come tax time, this is a tax strategy that they can use. So if anyone wants more information, here's my contact information. My cell phone number is 510-386-6699. 0872, or you can email me at geraldine@veritaxadvisors.com. That's GERALD as in David, N as in Nancy, at V as in Victor, ERITAX advisors.com. Anyone have any questions?
Got a question.
Sure.
So I think I remember you mentioned that if we meet the professional standards of like 750 hours as a real estate professionals, and the cost segregation is not going to benefit us as much, right? Or is it going to go against us?
You mean if you meet the IRS's definition of a real estate professional?
Yeah, because
Oh no, that's the most advantageous position to be in if you do a cost segregation study. So if you're a realtor and you know all the income you get from being a realtor, the results will go against all that income. But with a W-2 employee, it cannot be used to go against their income.
I see. So in that words, it actually benefits us more.
Correct.
I see.
And the other example that I want to make sure for those of you that are realtors or real estate brokers. So when you deal with investors, all they care about is the cash flow. So with looking at a cost segregation study, then if you show them the numbers from doing one, it just shows how it will help them with their cash flow, right? A cost segregation study increases your cash flow because, for example, in that story I gave above, and I know that I've been asked that, well, Geraldine, you know, what if we deal with lower numbers, right? A lower value property, like you buy a property like at 500,000, it's not that. So some people think it wouldn't make sense because you have a smaller valued property, but I have clients all over the country that pick up properties outside of the Bay Area at the, you know, for 100,000, 200,000. It's just that the fee's smaller and the benefits are smaller, but it's still, you still get that tax savings. So for example, if you bought a single family home in Colorado for 200,000, let's say it costs 2,000 to save 10 or 20,000 in taxes, the value proposition is, do you do a study and pay 2,000, or do you write a check to the IRS for 10, 20,000? Obviously, investors want to pay the lower amount. Did I answer your question?
Yeah.
Okay.
Yeah, for sure.
Any other-
So going off from there, so how do you guys charge?
So unfortunately for me, it's not based on the tax savings, because if it was, I would be retired by now and I wouldn't be talking about cost segregation. But it's a flat rate and it's based on the amount of work that that is required to do the report. So smaller the building, smaller the fee. Larger the building or number of buildings, higher the fee. And to give you an idea of what that looks like, you know, condo, ADU, single family home, anywhere from under 1,000 square feet to over 5,000 square feet, that fee is going to be anywhere from 2,000 to 5,000. But typically the tax savings is 10 times that amount. But, you know, we always do an estimate at no cost so you can see what the numbers look like, because you're going to want to know two things. You're going to want to know how much is it going to cost and how much do we think you're going to save in taxes. And from there, if you want to move forward, that's when you would sign a contract and pay a deposit to get the work started.
Thank you so much for the information. It really helps.
Any other questions? Well, if you do, just let me know. Feel free. Do we have a question? If you have any questions, feel free to reach out to me. You can give me a call or shoot me an email. I'm more than happy to talk to you about cost segregation if you have any other questions.